Welcome to my channel. In this video, I am going to walk you through the process of valuing Canadian natural resources stock by analyzing their financial statements and dissecting their financial ratios so we can determine if it's a buy or a sell. Canadian Natural Resources is engaged in hydrocarbon exploration, primarily in Western Canada and the UK. The company is headquartered in Calgary, Alberta, Canada, and started in 1973. It started trading on the Toronto Stock Exchange in 1995 and the New York Stock Exchange in 2000. The company produces 1,000 barrels of oil per day. 76% is petroleum and natural gas liquids. 24% was natural gas. It is the largest independent producer of natural gas in Western Canada and the largest producer of heavy crude oil in Canada. The company has reserves of 10 billion barrels of oil, of which 63% is synthetic crude. They also own 2 pipeline systems, an electricity cogeneration facility, and a 50% interest in the Northwest Redwater Partnership. We're going to look at the ticker that trades on the Toronto Stock Exchange. So all the numbers in this video are in Canadian dollars. Let's get started with the model. This is a large cap company, 41 billion market cap. They're trading at $35 a share and they have 1.2 billion shares outstanding. Let's look at the financials. The way you value a company is you estimate the free cash flows into the future and then you discount those numbers back to today's value. That's what we're doing in this video. And free cash flow is cash flow from operations minus capital expenditures. Their free cash flow peaked in 2018 at 5.7 billion. It's down to 3.1 billion in the trailing 12 months. Still a pretty strong number. Net income is the profit and loss on the income statement. It's revenue minus expenses. That peaked in 2019 at 5.4 billion, but was negative in the trailing 12 months. Revenue is a sales for the company. That was highest in 2019 at 24 billion. Then dropped to 18.6 billion in the trailing 12 months. This is the company's income statement. I get most of my information from Yahoo Finance, but Yahoo Finance doesn't have updated trailing 12-month information. They're using 2019, so I had to manually find it and put it into my spreadsheet. The top line is the revenue, the sales for the company. Below that is the cost of revenue. These are the expenses directly related to generating the revenue. An example is the cost of labor. Below that is gross profit, which is a difference between revenue and cost of revenue. That peaked in 2019 at 6.3 billion. It more than doubled from 2017. Below that is operating expenses. An example is depreciation. Then below that is operating income, which also peaked in 2019 at 5.6 billion. Below that is the interest they pay in their debt. And their interest payments seem to be growing from 600 million to 800 million. Below that is other income and expenses. This is usually impairments or other non-operational gains and losses. Then below that is pre-tax income, then their taxes. And the bottom line of the income statement is their net income. And they have positive and pretty strong net income each year. The reason they had negative net income in the trailing 12 months was not because their business was struggling. Although their revenue was down, the main reason was they took a large loss on the sale of an investment. So it was a non-operational loss. This is the company's statement of cash flows. The top line is operating cash flow. That's how much cash the company generates from its operational business. Then you have capital expenditures, which are investments in property, plant, and equipment. Operating cash flow minus CapEx gives you your free cash flow. And the company has a lot of free cash flow to work with. 2.5 billion. It was highest in 2018 at 5.7 billion. It dropped to 5.2 billion in 2019. The company looks like they're buying back stock with their free cash flow. They bought back 1.3 billion in 2018 and 940 million in 2019. When a company buys back stock, it decreases the shares outstanding, making your shares more valuable. They also pay $2 billion a year in dividend payments with their free cash flow. The most important part of any business is their operating cash flow. If you cannot generate positive operating cash flow, you don't have much of a business. You could think of operating cash flow as net income converted to cash. because net income is your accounting profit and loss. It's not actual cash. To calculate operating cash flow, you start with net income, then you have to add or subtract the non-cash items on the income statement. They pass through a $5.5 billion depreciation expense onto the income statement. That brings down their net income, but it doesn't affect cash flow. They also had $900 million in deferred taxes. That improved their net income, but we have to minus it out here on the statement of cash flows. $223 million in stock-based compensation, negative $215 million in other non-cash items, and negative $1 billion in changes in working capital. Even though they reported a $5.4 billion profit, they actually generated $8.8 billion of cash flow. Let's look at the capital structure. $32 billion of equity, $22 billion of debt. They're 60% equity, 40% debt, and their WACC is 9.6%, and that's a discount rate we're going to apply to the future cash flows. We estimated 4 years of future free cash flows. We also estimated a terminal value, which is all cash flows past year 4, that's $72 billion. We discounted those numbers back to today using the weighted average cost of capital. We get a value of the company of $64 billion. We divide that by 1.2 billion shares. And we get a calculated stock price of $54. They're trading at $35, so they're trading at a 36% discount. It's a buy according to the model. Simply Wall Street is a little higher than me. They're at $62 a share. They're also saying the stock is a strong buy. This is the stock price the last 5 years. It looks like it peaked at about $50, but it's come down quite a bit with the March crash. It has come up, but it's still trading at a discount relative to its pre-March highs. This company raises its dividend every single year. They're up to almost 5% dividend yield, and they pay out 65% of their free cash flow. That means they have 35% left to buy back stock, to pay down debt, or to grow their business. They have a really high beta, 2.28, so the stock moves more than 2 times the market. It's very volatile. The stock has gone up only 1.67% in the past 52 weeks, while the S&P 500 went up 17%. The 52-week low was $10, the high was $38, and the stock is trading above its 50-day and 200-day moving average. About 6 million shares are traded each day on this stock, and almost all the shares outstanding are on float. 73% are held by institutions, and less than 1% of the shares are shorted. If you invested $10,000 into this company 10 years ago, you'd be at $7,800 today. Not a good return on investment, an average annual loss of 3%. The biggest shareholder is Capital Research at 17.5%, then Fidelity, RBC, Vanguard, and BMO. Let's look at the financial ratios. The average PE in the market's 9, the median is 14. PE is stock price over earnings per share. To calculate earnings per share, that's net income over shares outstanding. They have negative net income, so they have negative PE. When a company has negative PE, we look to the price to sales ratio. Price to sales is stock price over sales per share. They're at 2.2. So investors are paying $2.20 for $1 revenue. That's a really good price to sales ratio. The average here and the median are for the entire market. You want to compare it against similar companies, which we'll do in a little bit. Price to book is stock price over book value per share. They're at 1.3, another really good ratio. Interest coverage ratio is EBIT over interest expense. They can cover their interest payments 6 times. ROE is net income over equity. They have negative net income, so negative ROE. Current ratio is current assets over current liabilities. They can almost cover their current liabilities with their current assets. And their current assets are $500 million in cash, $2 billion of receivables, and $1 billion of inventory. So the company does seem to have enough capital to get through the next 12 months, assuming they have similar free cash flow in 2021. Their trailing 12-month free cash flow is $3.1 billion. They have negative $100 million of working capital and a $2 billion dividend payment. They almost have $1 billion of funding. The best way to look at ratios to compare them to similar companies, I've done videos of 11 companies in the same industry as Canadian Natural. If the company has a number in red, they're worse than the average. If they have a number in green, they're better than the average. They're a lot worse in PE only because they had negative net income due to a large loss on the sale of an investment. They're better than average in price to sales and price to book. They're doing a bit worse in current ratio. They do have a negative ROE, but it's better than average because the average company has negative 16%. They're higher in debt than the average. And when I convert the market caps to Canadian dollars, they're much higher than average. They have the highest market cap of all the companies on this list. And they pay a really good dividend, almost 5%, average is 2.4%. So to summarize, I have them trading at a 36% discount. There's not much risk of this company going away. The Canadian government wouldn't let that happen. They provide such an important product and service to the community. And they're still generating pretty strong numbers. They are down a little bit, but who isn't in 2020? I ranked their free cash flow as 5 out of 10. I ranked their revenue 6 out of 10. And I ranked their ratio as 5 out of 10. So let me know what you think. Give this video a like, subscribe, or comment below. Also, if you'd like to get a custom valuation or just support the channel, you can become a member by clicking on the link in the description below. Thanks for watching.